Hello everyone. In today's lecture video, we will be covering chapter 13, which is about return, risk, and the security market line. So here in this chapter, we will be continuing with how to find the required return on a particular investment. So in chapter 12, we dealt with historic returns. Now what we will do is turn our discussion towards expected returns, and we will discuss risk and return and introduce the security market line. Our learning objectives here today are to know how to calculate expected returns, variance, and standard deviation based on expected returns. We will understand the impact of diversification, and we will also understand the systematic risk principle. So first, what we will do is talk about expected returns. So previously, we discussed how to calculate average returns and variances using historical data. So looking at previous returns and discussing what the average return was based on this sample size, and then what is the variance of the data that was provided. Here, what we will look at is expected returns. So an expected return is the return on a risky asset expected in the future. So a risky asset just means that it involves some type of risk. So it's not a risk-free security. Like we discussed with treasury bills in chapter 12, there's some amount of risk when we're calculating these expected returns on these risky assets. So expected returns are based on the probabilities of possible outcomes, and in this context, expected means average if the process is repeated many times. So this is like flipping a coin. So heads, I get $1, tails, you get $1. Over time, you would expect that you would have an even split of heads versus tails, but if I only flipped it once, then only one person is going to get $1. What we're doing here with this expected is calculating this average return based on different probabilities of possible outcomes. So the equation for calculating the expected return is to take, I apologize, my equations did not transfer over. You take the sum of each individual input, so the sum of the return of that particular security multiplied by the probability of some economic condition, and then you add this weight, or you add this average together to get the expected return of the entire security. So here, P sub I represents the probability of some economic state occurring. So looking at like a boom economy or a normal economy or a recession, that's what that P sub I represents. And then R sub I represents the return of the security under that particular economic condition. So the return if that particular state occurs. And so what we'll first start off with is calculating the expected return of a single security, and then maybe it will make a little bit more sense. So suppose that we have predicted the following returns for two stocks, stock C and stock T, in three possible states of economy. What are the expected returns? So the first thing that we would need to do is we can see that there is a 30% probability of a boom economy occurring, a 50% probability of a normal economy occurring, and then we would first have to identify what is the probability of a recession. Well, these three must add up to 100%. 100% probability of one of these three economic conditions occurring. So if we have a 30% probability of a boom and a 50% probability of normal, that would mean that there is a 20% probability of a recession occurring. Now, as you can see, we have this predicted data for stock C and stock T. So first, looking at stock C, we can see that in a boom economy, stock C would have a 15% return. In a normal economy, it would have a 10% return. And in a recession economy, it would have a 2% return. And then you can see the same here for stock T. And what we are asked to solve for is what are the expected returns of these two different stocks given the probabilities of these economic conditions. So let's first take a look at the expected return of stock C. So the expected return of stock C is the probability multiplied by the return in that economic condition, and we sum those together. So this equation is saying you take the 30% of a probability of a boom multiplied by the 15% return in that economic condition, and then what we do is we add to it the next set. We add to that the probability of a normal economy multiplied by the return in that condition, and then we add to it the probability of a recession economy multiplied by the return in that condition, and we get an expected return for stock C equal to 9.9%. Now, hopefully you can kind of work ahead here and look at the expected return of stock T. It's going to be the same thing. What we will be doing here is taking the probability of a boom multiplied by the return in that condition, plus the probability of normal multiplied by the return in that condition, plus the probability of recession multiplied by the return in that condition, and we end up getting an expected return for stock T equal to 17.7%. So that's what we're doing here, is calculating expected return of an individual security given different economic conditions and our expectation of the return in those different economic scenarios. Now, one other question here is if the risk-free rate is 4.15%, so let's say Treasury bills are offering a 4.15%, what are the risk premiums? So remember that the risk premium is the reward that you receive for taking some amount of risk, and it is simply the expected return. In this case, we'll look at stock C first. The expected return of stock C minus the risk-free rate. So what we have here is the expected return of stock C being 9.9%. minus the risk-free rate of 4.15%. So we get a risk premium for stock C equal to 5.75%. So you are compensated with an additional 5.75% return by taking the risk of investing in stock C. Now we can look at stock T. So you take the expected return of stock T minus the risk-free rate. So the expected return of stock T we calculated at 17.7%. multiply or subtracting the risk-free rate, and we get a risk premium of 13.55%. So here we have calculated the expected return of an individual security and also looked at the reward that we would receive by taking on this risk using expectations of different economic scenarios, so different probabilities for these different economic scenarios and the return of the individual securities within those scenarios. So here I have a quick quote here by Warren Buffett at the Berkshire annual meeting in 1989. So Buffett is considered one of the most successful investors in the world, and he stated at this meeting, take the probability of loss times the amount of possible loss from the probability of gain times the amount of possible gain. That is what we're trying to do. It's imperfect, but that's what it's all about. So that's exactly what we're doing here, is taking the probability of certain conditions occurring, what the return would be in those conditions, and then we're getting and then we're summing all of these different probabilities times returns together to get an expected return. So now we will move into variance and standard deviation. Well, what are variance and standard deviation? What do they measure? Variance and standard deviation measure the volatility of returns. Here we are using unequal probabilities for the entire range of possibilities. In Chapter 12, we dealt with samples, so that was a sample variance and a sample standard deviation based on some sample amount of data. Here, these formulas are for populations. So with the population is defined as all members of a specified group, and so what we're doing is calculating the variance and standard deviation for all possible outcomes. And the way that we are able to do this is that we are able, if you remember in Chapter 12, when we calculated variance, we took the sum of the square deviations from the mean and divided by n minus 1. We don't have to divide by n minus 1 when we are dealing with populations, because with populations, what we're dealing with is probabilities, and those account for all the possible outcomes. So calculating variance, it is a weighted average of the squared deviations, and once again, you can see my equation did not quite transfer here into my slide, so let me just fill this in quickly. So what we are still doing is taking the squared deviations from the average, our expected return, but instead of taking the sum of these and then dividing by n minus 1 like we did in Chapter 12, what we do is we take these deviations from the mean and we multiply it by the probability of each economic condition. So this is population, once again, population variance and standard deviation, slightly different equation than when we are dealing with samples, but we are still doing the same squared deviations from the mean, and we're still summing them together, but instead of dividing these sum of the squared deviations from the mean by n minus 1, each individual squared deviation from the mean we multiplied by the probability of that economic condition. So let's take a look at an example. Here, consider the previous example that we just talked about with stock C and T. What are the variance and standard deviation for each stock? So this is information that was already provided, the probability of the different economic scenarios, stock C and T's returned in each of these different scenarios, and then we calculated the expected return of stock C and the expected return of stock T. So first, let's do the variance and standard deviation for stock C. So once again, it is the sum of the squared deviations from the mean. So we take the return minus the average, we square it, and we multiply it by the probability of that condition. Then we add to it the difference of the normal return minus this average, we square it, and we multiply it by the probability of that economic condition. And then once again, we take the return in this scenario minus the average, we square it, and we multiply it by that probability of a recession. So we are still taking the sum, that's just the addition part of the equation, the sum of the square deviations from the mean, and we multiply each of the square deviations from the mean by the probability of those different economic conditions occurring. So this is our variance. It does not have a unit attached to it since we are squaring our inputs. And then when we take the square root of this for standard deviation, we get a standard deviation of 4.5, and it has the same unit as what our inputs were, which was percent. So we have a standard deviation of 4.5%. Now you can do the same for stock T. So just kind of giving you a heads up here as to what the equation is going to look like. What we are going to do is take the sum of the square deviations from the mean. So in a boom, we have a 25% return. We subtract the average, we square that difference, and multiply it by the probability of a boom economy occurring. We then add to it the return of stock T in a normal economy minus the average. We square it, and we multiply it by the probability. And then lastly, we would take the return in a recession minus the average, and then we square it. And then we take the sum of these values and we get a stock T variance, and you can check this with your own work to see that you're getting the same answers. And we get a variance of 0.007441. Take the square root of that, and we get a standard deviation of 8.63%. So these are variance and standard deviations for a particular year. So the next upcoming year, for example, based on probabilities of different economic scenarios or different economic states. So these are not based on past returns. These are based on expectations of future returns. Let's take a look at one more example here. So consider the following information. We have 4 economic conditions here. We have a boom, normal, slowdown, and a recession. You can see the probabilities of these different economic states. And then we can see that the return that we are looking at, or the stock that we are looking at, has these returns under each of the scenarios. First thing is to calculate the expected return. So once again, the expected return is going to be the probability multiplied by the return in that scenario plus the probability multiplied by the return, and we would do that for each scenario. So there is a 25% return of a boom economy. In that economy, Fresh Incorporated would have a 15% return. We add to that the probability of a normal economy multiplied by the return in that condition, 8%. Add to that the probability of a slowdown multiplied by the return in that slowdown economy, 4%. Plus the probability of a recession multiplied by the negative 3% return in that scenario, and we end up getting an expected return of 0.0805 or 8.05%. Now what we will do is calculate the variance. So variance is notated by sigma squared. Once again, it is going to be the probability of the condition, 0.25, and then the squared deviations from the average. The return in that condition is 0.15. We subtract the average that we just calculated, 0.0805. Notice I make all of these adjustments to decimals, and I square that difference. Then I add to it the probability of a normal economy, 0.5, multiplied by the squared deviation from the average. So the return in that case would be 8% minus 0.0805. We square that. We add to it. We do the same thing for slowdown. We have a 15% probability of a slowdown. In that scenario, we would have a return of 4% minus the average. We square it, and we do it one more time for the recession, where we have a 0.1% return, or a 0.1% probability, 10% probability. The return in that case is a negative 0.03 minus 0.0805, and we square it. So we take the sum of the square deviations from the mean multiplied by the probability of each economic condition occurring, and what we do is we end up getting a variance value equal to 0.002675. Again, no unit attached to that since we are squaring our inputs. For the standard deviation, we take the square root of that, and the standard deviation here would be 0.0517 or 5.17%. So that is calculating the expected return, the variance, and the standard deviation for a single security. What we will now do is expand past a single asset, and we'll turn our discussion towards portfolios. So with portfolios, a portfolio is a group of assets, such as stocks and bonds, that are held by an investor. Now, an asset's individual risk and return are important in how they affect the risk and return of the portfolio as a whole. Now, the risk-return trade-off for a portfolio, so remember that risk-return trade-off just means more risk should equal more reward, so that was discussed in Chapter 12. But the risk-return trade-off for a portfolio is also measured by the portfolio expected return, your trade-off, and standard deviation, the riskiness, just as it is when we've dealt with this risk-return trade-off for individual assets. Now, keep in mind that each individual investor has their own level of risk tolerance, so you can change this level of risk tolerance may change over time, and what will happen is that a financial advisor will create a portfolio based on your risk tolerance. So they will base their portfolio based on how much risk you're willing to take, measured by standard deviation, and your reward or your return on that will be based on the amount of risk that you feel comfortable taking when you're investing in a portfolio or a group of assets. So the first thing that we need to do is really break down portfolio construction. So the first thing that we discuss is portfolio weight. Portfolio weight is the percentage of a portfolio's total value that is invested in a particular asset. So what we'll do is we'll look at an entire portfolio and look at what the individual weights are of the securities that create or make up that portfolio. So here we have an example where we have $15,000 to invest. We've purchased securities in the following amounts. What are your portfolio weights in each security? So what we have here is $2,000 of Citigroup, and this $2,000 is a total market value of our investment, which is simply the number of shares multiplied by the share price. Total $2,000 of Citigroup. We invested $3,000 in Coca-Cola, $4,000 in Intel, and $6,000 in BP for a total of $15,000. So this is our entire portfolio. To calculate the weights of each of our inputs, we would simply take our weight in Citigroup divided by the total, and we would end up getting a weight of Citigroup of 13.3%. Coca-Cola, do the same thing. 3,000 divided by 15,000 total market portfolio. So we end up getting a weight of our portfolio being made up of Coca-Cola of 20%. Do the same thing for Intel. So 4,000 divided by 15,000. We get a weight of Intel of 26.7%. And then for BP, same setup. We have a weight of BP of 40%. Once again, these add up to 100%. They make up our entire portfolio, but that's our first step, is being able to identify what are the portfolio weights of the individual securities in the portfolio. Now, with portfolio expected returns, the expected return of a portfolio is the weighted average of the expected returns of the respective assets in the portfolio. So we are still calculating expected returns of individual securities, and then our expected return of the entire portfolio is simply a weighted average based on how much of our portfolio is made up of each individual security. And your equation says you take the expected return of each individual security multiplied by the weight of our entire portfolio of that security, and we add all of these together to get our expected return for the portfolio as a whole. Another way that you could calculate the expected return of a portfolio is find the portfolio return in each possible state, so recession, normal, boom, etc., and calculate the portfolio return in each possible state, and then compute the expected value just as we did with individual securities. So let's apply this and look at an example. So consider the portfolio weights that we computed previously. If the individual stocks have the following expected returns, what is the expected return for the portfolio? So we have calculated these portfolio weights on the previous slide. This expected return is given. We did not have to calculate this, so we did not have to do the individual weight or the individual return of the security multiplied by the probability of an economic condition and add those together. They have given us that final expected return, and they want to know what is the expected return of the portfolio. So looking back at the previous slide at the equation, it's rather straightforward. We are just simply taking the portfolio weight multiplied by its expected return, and then we add to that the next security's weight multiplied by its return. We add to that the next security's weight multiplied by its return, and we add to that the final portfolio weight multiplied by its return, and we get this weighted average where in this particular scenario, the expected return of the portfolio would be 15.41%. So as you can see, we've just taken weight multiplied by return plus weight multiplied by return plus weight multiplied by return, and we did that throughout. So That is calculating an expected portfolio return. We'll combine all of this stuff together in an example here upcoming. But we turn our discussion next to finding portfolio variance and standard deviation. So how do we measure the volatility and the dispersion of our portfolio returns based on the individual securities that constitute that portfolio? So with portfolio variance, we have 3 steps. Step 1 is compute the portfolio return for each state. So take the probability of the state multiplied by the return plus probability of state multiplied by the return and so forth. We would take the same steps as what we did with an individual security. Then step 2 is compute the expected portfolio return using the same formulas as an individual asset. Or you could do the weighted average of the expected returns of the respective assets in the portfolio, which is what we just did, the weighted returns of the individual securities. And then step 3 then is compute the portfolio variance and standard deviation using the same formulas as what you would do with an individual asset or an individual security, using the probabilities of the different economic conditions. So keep these steps in mind. We'll work through these here on the upcoming 2 examples, really combining everything and now looking at it from a point of view of evaluating a portfolio as opposed to a single asset. So here we have example 1, portfolio variance. So consider the following information on returns and probabilities. We invest 50% of our money in asset A. We can see that here we have a 2-asset portfolio. So if 50% of our investment is A, that means 50% would be in B as well. So what we have here is we have a 40% probability of a boom economy, a 60% probability of a bust economy, and then the returns of A and B under each of the scenarios. So number 1 here wants us to know what are the expected return and the standard deviation for each asset. So we're going to look at asset A and asset B expected return, standard deviation, doing what we did in the first part of the chapter where we were looking at the expected return and the volatility of individual securities. And then we'll combine all that and introduce what are the expected return and the standard deviation for the portfolio. So what I've done is I've created an additional slide since we will have a little bit of work here. So step 1 or question 1 was to solve for the expected return and the standard deviation of each asset. So let's first look at asset A. So the first thing that we are going to do is calculate the expected return of asset A. So as we discussed previously, it is the probability of each economic condition multiplied by the return in that condition, and we sum those different products together. So we have a 40% probability of a boom. In a boom economy, asset A has a 30% return. And we add to that the probability of a bust economy multiplied by the negative 10% return, and we get an expected return of 6%. Now let's calculate variance and standard deviation. So once again, variance is notated by sigma squared, and once again, it is the probability of the condition multiplied by the squared difference of the return in that condition minus the expected return, the average. So what we have here is a 30% return in a boom economy minus the 6% average. We square that difference, and then we're going to do the same thing for part 2. We take the 60% probability of a bust. In a bust economy, we have a negative 10% return minus the expected return of 6%. We square that difference. And so remember, your order of operations would tell you to do the parentheses, and then we square it and then multiply it by the probabilities. When you do these calculations, you end up getting a variance equal to 0.0384. And what you should be doing is verifying these and making sure that you are getting the same answers here as we work through these problems. And then to calculate the standard deviation, that's just the square root of the variance, and we get a standard deviation of asset A. And oftentimes they'll notate with a subscript of whatever you're evaluating. And we get a standard deviation of asset A equal to 19.6%. Let's do the same thing for asset B. So we are calculating the expected return and the standard deviation of each individual security. So here what we have for asset B, we are calculating the expected return of B. You may wish to pause this at this time and kind of work through it on your own and see if you can get the same answers. But again, it's probability multiplied by return in that scenario, and we add that we add together the different products for the different economic conditions. So we have a 40% probability of a boom. In a boom economy, stock B has a negative 5% return. and we add to this the probability of a bust economy, and in a bust economy, asset B has a 25% return, and what we end up getting is an expected return of 13%. Now you can see that I've already made the conversion. I would have gotten an answer of 0.13. I've already converted it to 13% for viewing purposes. But that would be the expected return of asset B. Now let's calculate the variance of asset B. Once again, it's probability, 0.4, multiplied by the difference between the return in that condition minus the expected return, and we square that. And then we do the same thing for the next one. Probability of a boom, 60%. In a boom, we have a 25% return minus the expected return of 13%. We square that difference. We end up getting a variance of asset B equal to 0.0216. And you may want to do each individual product and then sum them together. I'm just giving you the final answer here. Take the square root of this for the standard deviation of asset B, and we get a standard deviation equal to 14.7%. You would have gotten 0.147 or 14.7% as your standard deviation. So that is part one of the question, asking us what are the expected return and the standard deviation of each asset. Now we look at the portfolio as a whole. What are the expected return and standard deviation for the portfolio? If you go back to the steps, step one is to calculate the portfolio return for each state. So let's take a look at, in a boom scenario, if we have 50% of our assets or of our portfolio invested in A and 50% of our portfolio invested in B, in a boom economy, we would have 50% of our portfolio in A have a 30% return, and then 50% of our portfolio in B have a negative 5% return. So the return of the portfolio in a boom economy would be 12.5%. This is the portfolio return in this boom scenario. Now let's look at a bust scenario. Again, 50% of our portfolio, we are already assuming, we're not using the probabilities in this step. We're assuming that this bust economy occurs. And if 50% of our portfolio is A, and A has a negative 10% return, and 50% of our portfolio is in B, and B has a 25% return, then the expected return of the portfolio as a whole is 7.5%. So that is our portfolio return given the assumption that the bust economy occurs. So step one is compute the portfolio return for each particular state. Step two, and you can go back to these steps if you're confused or anything, step two then is compute the expected return of the portfolio. Now we start to use these probabilities. So probabilities and returns. So you calculate the expected return the same ways what you would do for an individual security, except here we are calculating the expected return of the portfolio. There is a 40% probability of a boom economy. In a boom economy, the portfolio returns 12.5%. And then we add to that the probability of a bust economy multiplied by the portfolio return in that economic condition. And we get an expected return of the portfolio as a whole of 0.095 or 9.5%. So this is the same thing that we did with an individual security. We just had to first identify what are the portfolio returns based on our portfolio weights in the individual securities. The other way that you could do this, by looking at the individual assets, you could technically and get the same expected return for the portfolio. I'll showcase this to you. If 50% of our asset is, or of our portfolio is invested in A, and A has an expected return of 6%, and 50% of our asset is in B, or of our portfolio is in B, and B has a portfolio return of 13%, you would get that same 9.5% expected return. So there are two different ways in which you could calculate expected return. In this scenario, I showcase first calculating expected return using the portfolio returns under each individual economic state. And then part two here, or in the second part of question two, I calculated the expected return of the portfolio based on the individual securities returns and their construction or their weight in the overall portfolio. Now, step three then is to calculate the variance and standard deviation of the portfolio. So once again, it's the same setup. So now we're calculating the variance of the portfolio. We take the probability of a boom, and then the difference between its return and the expected return overall, and we square that difference. So it's still going to be the sum of the squared deviations from the average, and we are incorporating the probabilities as well. So we have a 40% probability of a boom. In a boom economy, the portfolio has a 12.5% return minus the expected return or the average, and we square that difference. Add to it then for the squared difference between in a bust economy. So 60% probability of a bust economy. In the bust economy, we have a 7.5% return on the portfolio minus the expected return overall of 9.5%. We square that difference, and we end up getting a variance of the portfolio equal to 0.0006. Taking the square root of that to calculate the standard deviation, we get a standard deviation that is equal to 0.0245 or 2.45%. And so what we see here with this portfolio is that we are actually still able to get a return that is between the returns of the individual securities. So the individual securities had expected returns of 6% and 13%. When we combine them into a portfolio, we get expected return of the portfolio between the two. But notice that the volatility measured by standard deviation is substantially lower than the individual securities. This is the whole concept behind diversification. We'll talk about this more in the upcoming slides. But do notice that our portfolio standard deviation is not based on the portfolio of the standard deviation of the individual securities, but they are based on the returns and the volatility of the returns of the portfolio as a whole. So that is combining everything together with individual securities, different economic conditions, and calculating portfolio expected return, variance, and standard deviation. Let's apply this one more time and do another example and see if we have this figured out. Okay, so here with another example, let's consider the following information on returns and probabilities. Here we have, again, a 2-asset portfolio, assets X and Z, and here we have 3 economic conditions. We have a boom, a normal, and a recession in the economy, and they want to know what are the expected return and standard deviation for the portfolio if 6,000 of our portfolio is invested in asset X and 4,000 is invested in asset Z. So the first thing that we should do is calculate the weights of stocks or assets X and Z in our entire portfolio. So X is simply going to be 6,000. Our total portfolio is 10,000 if you add together those two. So 60% of our portfolio is made up of asset X. And so Z then would be the 4,000 divided by 10,000, or 40% of our portfolio is in asset Z. Now what we are going to do is work through our different steps in calculating expected return, variance, and standard deviation. And once again, I've put this on another slide just so that since we will have a little bit more work here. So the first thing, step 1, is to calculate the portfolio return for each state. So let's take the expected return in a boom economy. So once again, we are assuming that this is occurring, so the probabilities do not come into play, but we do have 60% of our portfolio in X, 40% of our portfolio in Z. Those are our portfolio weights that we just discussed. And if we assume that a boom economy occurs, if 60% of our portfolio is in X and X has a 15% return, then we add to that the 40% of our portfolio that is in Z multiplied by its 10% return. And if the boom economy does occur, our portfolio will have a return of 13%. Do the same for normal. So what is the expected return in a normal economy? Once again, 60% of our portfolio is in X. X has a 10% return in this scenario. 40% of our portfolio is in Z. Z has a 9% return in this scenario. So the expected return for the portfolio as a whole would be 9.6%. And you can see I've already made the adjustment from decimal to percent form in my final answer. And so here I have the expected return in a recession, which is once again 60% in asset X multiplied by its 5% return, 40% in asset Z multiplied by its 10% return. And if the bust economy occurs, then our expected return of the portfolio would be 7%. So step 1 is compute the portfolio return for each state. Step 2, compute the expected return of the portfolio as a whole. Now we incorporate these probabilities. So once again, probability of occurrence multiplied by return, plus probability of occurrence multiplied by return, plus probability of occurrence multiplied by return, and we take the sum of those, and we would get the expected return of the portfolio. Now just writing out what I just verbally said, there's a 25% probability of a boom. In a boom economy, the portfolio has a 13% return. We add to that the probability of a normal economy, which was 60%. In that state, the portfolio has a 9.6% return, and we add to that the probability of a recession. In that state, the portfolio has a 7% return, and we get an expected return for the portfolio equal to 10.06%. Step 3 in calculating portfolio variance and standard deviation would be to calculate the variance and standard deviation in the same manner as if we had a individual security. So here we are calculating the variance of the portfolio. Once again, it is the probability of the economic condition. Let me just kind of circle these again. Boom, the return in a boom, minus the expected return, and we square that difference. So we have a 25% probability of a boom. In a boom, we have a 13% return, minus the average or the expected return, and we square that difference, multiply it by the probability. Do the same here for a normal economy. So here we have a 60% probability of normal. In a normal economy, the portfolio has a 9.6% return. We subtract the expected return of the portfolio as a whole, and we square that difference. So we have 0.096 minus 0.1006. Square that difference, and then we do the same thing for a recession. So one more time here. Probability of recession multiplied by the squared difference. 7% minus 10.06%. So we have a 15% probability of a recession. In a recession, a 7% return for the portfolio minus 0.1006. We square that difference. We end up getting a variance value that is equal to 0.000369. Again, no units since we are dealing with variance and we squared our inputs. And so to calculate the standard deviation, then we take the square root of that, and we get a standard deviation that is equal to 1.92%. Now, if you were to look at X and Z and calculate their standard deviations and expected returns, as opposed to the portfolio as a whole, you would realize that the diversification component that we discussed on the previous problem does, in fact, play out once again. So we do have an expected return between the two individual securities, but the volatility substantially decreases between the individual volatility of stocks X and Z, and that is what diversification brings. So, continuing on with a further discussion on risk. So we've been talking about expected returns. Now let's talk about risk. Risk and return always go hand in hand. Let's dive into risk a little bit more in depth and identify the different components of what goes into the riskiness of a security. So there's two main types of risk when we're talking about investing in stocks. The first type of risk is what is called systematic risk. And this is a risk that influences a large number of assets. It's also called non-diversifiable risk or market risk in the fact that systematic risk affects the entire stock market. It includes such things as changes in GDP, inflation, interest rates. So if there's any condition that impacts the entire market, it's not about the actual condition, it's about what its impact is. But if the impact affects the entire market, that is what is a systematic risk present with investing in stocks. The other type of risk is unsystematic risk. So this is a risk that affects at most a small number of assets. It's also known as unique risk and asset-specific risk, and it includes such things as labor strikes, part shortages, etc. So with unsystematic risk, this is your firm-specific risk or your asset-specific risk, is a risk that at most affects a small number of assets. Now, combining return and risk and breaking down returns a little bit further, as we previously have said, total return is equal to expected return plus your unexpected return. Okay, so with your expected return and your unexpected return, our total return has two different components. Now, your realized return, so this total return, your realized return is generally not the same as your expected return. And it's because of this unexpected portion of our return. So this unexpected portion is what causes price changes in an efficient market, which we discussed in Chapter 12 about the different levels of an efficient market. Now we can go and break down that unexpected portion into the systematic portion, so the portion that would affect the entire market, and then a firm-specific portion, your unsystematic portion. So as a result, what we can do is we can break down total return and understand that your total return on an investment has three different components: what you expected based on your analysis, and then that portion that was that impacted the entire market, your systematic portion, and then your unsystematic portion, your firm-specific portion. So as we look at this total return, the next way that the next direction that we turn our attention to is there a way? We just said that risk is broken down into a systematic portion and an unsystematic portion. Is there a way that we can limit one of these types of risk when we create a portfolio? And that leads us into this whole concept of diversification. So portfolio diversification is the investment in several different asset classes or sectors. So diversification is not just holding a lot of assets. So for example, if you own 50 internet stocks, you are not diversified. This goes back to your, as you've probably heard in the past, don't put all your eggs in one basket. Diversification is investing in multiple different asset classes or sectors. So for example, if you own 50 stocks that span 20 different industries, then you could say that your portfolio is diversified. Why is it important? Why is it important to have a diversified portfolio invested in multiple asset classes or sectors? Well, let's take a look at a chart showcasing the number of stocks in a portfolio and the average standard deviation of the returns of that portfolio. So remember that standard deviation is our measure of risk, our measure of volatility. And what we have here is a random selection of stocks on the New York Stock Exchange. And notice that as we increase the number of stocks in our portfolio, what happens to the standard deviation of our portfolio returns? The standard deviation decreases. So the volatility of our returns decreases as the number of stocks in the portfolio actually increases. And so it leads us to the principle of diversification. So diversification can substantially reduce the variability of the returns measured by the standard deviation without an equivalent reduction in your expected return. This reduction in risk arises because worse than expected returns from one asset are offset by better than expected returns from another. So we have this unsystematic portion where the unexpected firm-specific risk may benefit one asset and then hinder another asset, but they tend to balance each other in a well-diversified portfolio. However, there is a minimum level of risk that you cannot diversify away, and that is the systematic portion. So that's your market risk. Another way of diversification is investing internationally. So another means of diversifying your investments across multiple asset classes and sectors. So taking a look at a chart of the previous information, discussing the standard deviation of a portfolio and how it decreased as we increase the number of securities in the portfolio, we can see that as we increase the number of stocks in the portfolio, our standard deviation here decreases as we increase this number of portfolios here. And what we can identify is that this part that is decreasing is the unsystematic portion. This is our firm-specific risk, which we can diversify away as we increase the number of stocks in our security or in our portfolio. But there is a type of risk that we are unable to diversify away as it affects the entire market, and that is your non-diversifiable risk, or otherwise referred to as your systematic or your market risk. So going back to this diversifiable risk discussion. So diversifiable risk is the risk that can be eliminated by combining assets into a portfolio. It's often considered the same as unsystematic risk or unique risk or asset-specific risk or firm-specific risk. If you are holding only one asset or assets in the same industry, then you are exposing yourself to risks that you could otherwise diversify away. Now, this whole concept of diversifying away is if you have investments in multiple different assets and asset classes, if one asset were to decrease, then other asset classes or sectors could increase and would offset that risk. So the unsystematic portion can actually be diversified away by incorporating multiple securities from different asset classes and sectors, whereas the market risk is the type of risk that is present on all securities and is unable to be diversified away. So looking at total risk defined, remember that total risk measured by standard deviation has two components, your systematic risk and your unsystematic risk. Realize that the standard deviation of returns is a measure of this total risk. And so for a well-diversified portfolio, this unsystematic portion should be close to zero. It should be very small. So consequently, the total risk for a diversified portfolio is essentially equivalent to the systematic risk, the market risk of that portfolio. So all of the firm-specific risk has been diversified away. You're only left with the market risk of that portfolio. And what this leads us to then is what is called the systematic risk principle. Now, we know from Chapter 12 that there is a reward for bearing risk, your risk-reward trade-off. However, there is not a reward for bearing risk unnecessarily. So there is not a reward for taking on risk that you could otherwise diversify away. And so the systematic risk principle states that the expected return on a risky asset depends only on that asset's systematic risk. This is because the unsystematic risk can be diversified away, and you're only compensated for the risk that is unable to be diversified away. So you're probably asking yourself, okay, well, how do I measure the amount of systematic risk in a particular asset? We measure systematic risk by introducing what is called the beta coefficient. So the beta coefficient looks something like this. Basically, it measures the risk of the entire market. It measures how a security correlates with some type of market index. So this beta coefficient is the amount of market risk or systematic risk present in a particular risky asset relative to that in an average risky asset. So some asset that has the same systematic risk as the market. So what does beta tell us? If we have a beta of 1, it implies that the asset has the same systematic risk as the overall market. So it tends to move in the same direction as the market. So if the market increases 1%, it also increases 1% on average. If the market goes down 1%, it also goes down. It has the same amount of risk as the market as a whole. Now, if a beta is less than 1, for a particular security, that asset has less systematic risk than the overall market. So it does not have it does not fluctuate in price as much as whatever that market index is that's being used. And then a beta greater than 1 implies that the asset has more systematic risk. So it's more volatile than the market as a whole. So with beta, it's really just telling you how much a stock's price moves in relation to some market. And by market, typically it's some type of index. So something, for example, like the S&P 500 index. How does one particular security move in relation to that index? So if the index goes up 1%, what happens to this stock price relative to that change in the market index? Now, if a stock has if a security has a beta of 0, that means it's a risk-free asset. It does not fluctuate at all in relation to that market, so your treasury bills would have a beta of 0. So looking at some selected betas of some companies that you're probably familiar with, we can see Coca-Cola, Kellogg, Microsoft. Again, this is from 2014. So in 2014, these companies had pretty low beta coefficients, meaning that they had less systematic risk than whatever market index you were looking at. And then you can see as we get up towards like Tesla, JCPenney, Abercrombie, and these are probably much different now in 2021. But as you can see here, these betas, these companies have more systematic risk than the market as a whole, represented by a beta coefficient that is greater than 1. In the case of Abercrombie and Fitch, much higher than much higher than 1 for the beta coefficient, much more systematic risk. So looking at total versus systematic risk, let's just look at the following information. Here we have stock C and stock K. Let's make sure that we understand the difference between standard deviation and beta. Remember that standard deviation measures total risk, beta measures systematic risk. So which security has more total risk? This is based on the higher standard deviation, which measures systematic and unsystematic. So security K would have more total risk because it has the higher standard deviation. Which security has more systematic risk? This would be the company with the higher beta. So here security C has the higher beta, the higher amount of market risk. So which security should have the higher expected return? This is where we understand that you are compensated for the amount of systematic risk that you take. So security C should have the higher expected return. Even though security K has more total risk, we should be able to diversify away some of that unsystematic portion. We should be able to diversify away that firm-specific risk, and we should only be compensated for the amount of market risk that we take. So a greater risk premium here due for security C, since we are taking on more systematic risk. Now, we conclude here with being able to calculate the beta for an entire portfolio. So you can calculate the beta for an entire portfolio if you know the betas of the individual securities. And once again, it's just a weighted average. So to calculate the portfolio beta, we are going to take the weight of our portfolio invested in Citigroup, multiply it by its beta, add to it the amount of our portfolio invested in Coca-Cola, multiply by its beta, and do the same for Intel and BP. So what we have here is the portfolio beta is going to be equal to the weight in Citigroup multiplied by its beta. As you can see, substantially high beta, a lot more market risk than the market than the market index. And then we do the same for Coca-Cola. Add to it the weight in Intel multiplied by its beta, and then the weight in BP multiplied by its beta. And you end up getting a beta for the portfolio that is equal to 1.947. So the portfolio has more systematic risk than the market as a whole. Once again, your financial advisor can create a portfolio based on your level of risk tolerance. So they may include these securities, these individual securities that have higher betas, more systematic risk, trying to get a higher return, but also understanding that with this risk, you could also have lower returns in particular years as well. So which security has the highest systematic risk? Here we're looking at the beta, so Citigroup. Which security has the lowest? Coca-Cola. And is the systematic risk of the portfolio more or less than the market? It is more, because the beta is greater than 1. So that concludes our discussion here on Chapter 13, looking at risk return and the security market line. If you have any questions about anything, please don't hesitate to reach out. This really leads you into a discussion on the capital asset pricing model. So now if you are doing some individual research on your own, you could kind of look into that capital asset pricing model, as this material leads right into that. So email if you have any questions, and I look forward to talking with you all soon. Thanks. Bye.